Good day, students. I will be doing the June exam for the year 2017, and I would like students to go through this as part and parcel of the revision. And we'll only start with question 1, then I will only do question 1 because this question is the major question and it counted more marks, which is 54 marks out of the 70 marks, and I will do only the major questions, which is the general entries, the income statement, and the statement of financial position, together with the statement of changes in equity. The first entry says this, that Busi Mabuta is a qualified plumber whose business, which is BM Plumbing, is growing due to his quality of work and word of mouth referrals. Busi, however, needs help since he is not so clued up on accounting terms as special adjustments. You are required to use the pre-adjustment trial balance and the additional information provided to you by Busi on the last day of the financial year. Process this information and compile the information required below. So now we are required to analyze the pre-adjustment. It means this is before the adjustments were taken into account. We must look at the pre-adjustment balance of BM Plumbing. That is for the year ended 31st of December in the year 2016. So meaning the accounting period for this business ends on the 31st of December each and every year, and we are dealing with the current year, which is the year 2016. Then we are given our trial balance, and going down in our trial balance, just browsing the very critical items that we see here, it is the allowance for credit loss of 5,000 rands. This will be very critical. And we also have the prepaid expense on the first day of the year, which is the beginning of the year, 1st of January 2016. And that prepaid expense was 3,000 rands, and we know that prepaid expense is an asset. Therefore now this has to be reversed, and when the reversal is done, then that prepaid expense will have to be recorded on the credit side, where we cancel the prepaid expense, because to cancel a debit entry, it has to be recorded on the credit side. We are then required, or we are then given the bank overdraft. Take note of that. Bank overdraft is a liability. That means this business was owing 1,770,000 by the end of the current accounting period. So now this 1,770,000 will be recorded under our current liabilities. And it says 12% long-term loan from Water Bank. That means there was a loan of 50,000 that was taken from Water Bank, and this 12%, it means out of the 50,000 that the business borrowed, then they will have to pay interest of 12%, and this 12% is per annum. That is the interest that the business supposed to pay for the full year, meaning it will be 50,000 rands, multiply that by 12%, meaning 6,000 will be the interest that is supposed to be paid for the full year, 6,000 rands. However, by just looking at the bottom here, we have interest expense of 4,500. This is the interest that was already paid, and this is the interest that was supposed to be paid. So now obviously there is a difference between the two, meaning now there is a difference of 1,500 that still need to be paid. So now the 1,500 will be an accrued interest expense, and we know that an accrued interest expense is a liability which will be recorded under trade and other payables in the statement of financial position. So now we have calculated that interest, then we continue and we check what is the next entry. which is the very important entry to highlight. Trade payables, that is, we'll see that as time goes on. We have income received in advance, and that income is on the first day of the year, and that was a liability because income received before time or income received in advance is a liability. So now we have to make a reversal of that, and to reverse a liability, it has to be recorded on the debit side. That means when we make a reversal, income received in advance will have to be debited, and we credit the income that was received in advance. Then now we have service income, we have credit loss, and all other expenses are just given to us. We'll analyze all those as the time goes on. So now let us check what we are required to do before we can proceed further, because I always prefer that approach. So now here are the adjustments first that are given to us. However, I will do the adjustments after I have done all the rough draft of my financial statements. So now we are required here to record point number G, H, I, and J in the general journal. And let me just say, I will record all, not only A, G, H, I, and J. I will record all the entries that appear in our adjustment. However, this is what is required, but I will record everything so that we see how everything ties up together with regard to the financial statements. And it says no narrations are required. So now we are going to the second requirement, which says show how the relevant information will reflect on the trade receivables and the water and electricity account in the general ledger. So now we are then required to record this in the ledger account. However, due to the time constraints, I will not be doing this ledger account. And 1.3, we are required to draw the statement of comprehensive income. Then I will do 1.3, and 1.4, we are required to draw the statement of financial position. Then I will do 1.4. Meaning that I will do 1.1, 1.3, and 1.4. I will do that, and because of time, obviously, I know that I will not be able to reach to 1.2. Then I will only do the main questions. However, later on, I might do later accounts on this exercise. So now it means we first have to start drawing, and this is always my approach when I deal with the financial statements. I prefer to start by drawing the skeleton of the statement of comprehensive income. Then after I do the skeleton of the statement of changes of financial position, then together with the statement of changes in equity when it's required. So now this will be my number 1, number 2, and this will be my number 3. Then after I will be compiling and consolidating all the financial statements and recording the effect of such in from the journal entries to the financial statements. So now this is how I will answer this question in terms of my structure or strategy to answer this question. 1 will be 1.3, and number 2 will be 1.4, and number 3 will be 1.1. So now let me start by doing number 1, which is my number 1 being 1.3, where I draw the skeleton of the statement of comprehensive income from the information that is given to us here. So now let us do that together, and we'll see how far do we go with this statement. So now statement of comprehensive income. Statement of comprehensive income. We start with that statement, and we say statement of, this is 1.3, statement of comprehensive income for the year ended 31st December 2016. For the year end 31st December 2016, 31st of December 2016. Then now we start with the first entry, where we start with the revenue that we have. And our revenue, it is service income. Our revenue is service income. Let me just write this in brackets. Then we check how much is our service income. Our service income, here is our service income given to us. and that service income is 5,360,000 rands. 5,360,000 rands. So we write that as 5,360,000 rands. Then if there are adjustments, we'll have to effect such adjustments. But so far, we don't know what adjustments do we have regarding the service income. Then the next one now will be to less our expenses, to subtract all the expenses, less expenses. And we list all the expenses that we have from the trial balance. In the trial balance, we have credit loss, and after credit loss, we have interest expense. We'll put that later. Salaries, consumables, rent expense, insurance, water, and electricity. Then let us record all of that. We have credit losses. We have credit losses. Then after we have salaries. Then after we have consumables. Then after, let me check all of them. Our credit loss amounted to 7,500. Then let us write that credit loss 7,500. Our credit loss is 7,500. Then after we have our salaries, and our salaries are given to be 400,000 rands. Here are the salaries. Then we record our salaries as 400,000 rands as they appear in the trial balance. We're just recording, guys, everything that is given to us so far. Our consumables are 500,000 rands. Our consumables are 500,000 rands. And we record that 500,000, and we look for another expense. I think we had water. Okay, we have rent expense. Then we record that rent expense under our expenses. And our rent expense is given to be 570,000. That is 570,000 is our rent expense as it appears in the trial balance. Then after we have water and electricity or we have insurance of 14,000, then water and electricity of 85,000. We have insurance of 14,000. Then after the insurance of 14,000, then we insurance of 14,000. Then we have water plus electricity. We have water plus electricity. And our water plus electricity, it was 85,000. Water and electricity is 85,000. Then after we have to make provision for depreciation because there might be depreciation since we have depreciable assets. And here are our depreciable assets that we see in the trial balance. We had equipment, we had vehicles, and they also do have their accumulated depreciation. So now there is surely a situation where we have to calculate our depreciation for these assets. Then after we also have to take into account which other provision can we make is all that I can think of so far. Then after we have to account for the interest expense at the bottom where we have to record our interest expense if there was interest expense, and I think there was interest expense. So now, yeah, there is the interest expense. We have to record our interest expense of 4,500. So let us just leave a line here, then we'll have interest expense. We have interest expense. Then after we'll get to the profit for the period, and our interest expense is 4,500 rands. So now we have recorded all of this. Let us do the next statement, which is the statement of financial position. Remember, guys, I'm just doing the rough draft. We are doing the statement of financial position, and this is 1.4. We are doing the statement of financial position at 31st of December in the year 2016. 31st of December in the year 2016. And we know that this statement starts with assets, and under assets we have non-current assets. Under non-current assets we have property, plant and equipment. And under property, plant and equipment, we first have to record the item of property. If was there any property, here we have a property of 3 million. We record the 3 million as it is. We record the 3 million, 1, 2, 3, 4, 5, 6. Then after, we also have to add the other assets. In this case, we have other assets being equipment. The cost of equipment was 2,500,000 rands. Then we record equipment 2,500,000 rands. Then 2,500,000 rands. Then we check for another asset, and another asset is vehicle, and the cost of the vehicle is 2,550,000. Then the vehicle is 2,550,000. We say 2,550,000. Then after, we have to subtract the accumulated depreciations that are already given in the trial balance. And here we are given the accumulated depreciation on equipment, and that accumulated depreciation on equipment is given to be 500,000 rands. Then we record what is given, because accumulated depreciation reduces the value of the asset. Then after, we also subtract the second accumulated depreciation, and that second accumulated depreciation is for the vehicles, which is at 800,000 rands. That will have to be recorded as 800,000 rands. So now remember, there are still depreciations for the current year that will have to be accounted for. So now we'll subtract all the depreciation for the current year when we arrive to that stage. So now in this case, we are just recording all the rough draft of what is necessary in this part. Then after, we have our current assets, and under our current assets, we know that we start with the item of inventory, if there was inventory. So now I think there was consumables. If we have consumables, that will be inventory of consumable items. I think we had some consumables along the way. Here we had our consumable items, consumables of 500,000 rands. So now we can record that, because we don't know what has been left at the end of the period. Then we write that as consumables, and we open brackets and we say 500,000, because this is the consumable that were bought during the year. So now if they were used during the year, that we don't know. Then after, we record our trade and other receivables. We record our trade plus receivables, trade plus other receivables, trade plus other receivables. And under trade and other receivables, we start by recording our trade and other receivables, or our trade receivables amount. And in our trial balance, we are given our trade receivables, which is 2,880,000. So now we record that 2,880,000. Then if there are other items of trade and other receivables, we'll have to take them into account when it comes to this line item. Then now here we will not have the bank. Why? Because our bank was a bank overdraft, meaning that 1,770,000 will be recorded under trade and other, or under current liabilities. Then after, we go to equity and liabilities, where we record the equity plus liabilities. Equity and liabilities, and under equity and liabilities, we start with the amount of the equity. And the amount of the equity will begin by the capital that we see in our trial balance. And in our trial balance, we do have a capital of 3 million, and that is the one that we start with. And remember now, in this case, this could be a capital on the 1st of January in the year 2016. So now this is at the beginning, which will be an opening balance. Remember, in this case, we are not required to do the statement of changes in equity. That means we have to do all the workings under the statement of financial position. However, I can just do the rough draft of that statement. And we know that there are drawings that will always affect our statement of changes in equity on a negative. So now if we do have drawings, then we can record our drawings immediately, because we know that drawings are negative in the statement of changes in equity. And from this, we do see that there are drawings that the owner did, and those drawings amounted to 50,000 rands. And we can deduct that 50,000 because we know that drawings, they reduce equity. So now we can so far say less 50,000 rands. We're just recording, guys, the rough draft of the statement of everything that is given so far. Then now we go to our liabilities, and we know that under our liabilities, we have non-current liabilities, we have non-current. And under non-current, I think there was a loan, but we don't know either the loan was a long-term or a short-term loan. Or that is 12% long-term loan from Water Bank. So now that is a long-term loan, meaning we can provisionally record that 50,000 under our long-term loan. Then we have long-term loan, and we record that long-term loan as 50,000 rands. There might be an adjustment with regard to the current portion of the loan. So now we must just leave this as long-term loan in brackets 50,000 rands. Then now we go to current liabilities, and under our current liabilities, we start with our trade and other payables. Then after, we record all others after that. Then we start with the trade plus other payables. Trade plus other payables. Our trade plus other payables, we check them from the trial balance, where we start with the trade payables, because we do have our trade payables. Our trade payables, they are given in the trial balance as an amount of 1,075,000. That is our trade and other payables. Then we record that 1,075,000 rands as our trade and other payables. Then after, we know that there was if there's the current portion of the loan, that will be recorded, but there was a bank overdraft that we know that the business by the end of the year owed the business, so owed the bank. So now our bank overdraft will be recorded as an amount of 1,770,000. There was the bank overdraft of 1,770,000 rands that will be recorded as our bank overdraft. Let me just say bank overdraft. So now our bank overdraft, we will in brackets say 1,770,000 rands. If there's a current portion of the loan, we'll record that here at the bottom, but I don't want to make provision. If there is, we'll just record the current portion of the loan, but we don't know if there's a current portion or not. Now, we have recorded the rough draft to all the financial statements that are necessary. Then we will be doing 1.1. And 1.1, we are doing general interest. We are doing general interest. General interest. And we are doing all of them. Remember, I said I'm doing all the general interests, and I'm doing all of them. I will do all of them as the workings. Then I'll only mark those that are required in the exercise. So now we are doing all the adjustments, and immediately as we do the adjustments, we record them where they're supposed to be recorded in terms of the financial statements. So now that is the importance of doing the rough draft of what is already given in your financial statements before you start with the adjustments, because if you don't do this, it will cost you time in terms of going back and check if was this an accrued, was this a prepaid, where does it go, all that stuff. So now I'll be doing 1.1, and for every journal entry that I record, I will immediately write the effect of that in the given financial statements that I've done the rough draft of. So now we will be beginning with the journal entries that are given to us. Don't forget that we have reversal entries that must always be taken into account. there was a reversal entry of the prepaid expense, but we don't know what was this prepaid all about of 3,000. And there was income received in advance, and we don't know what was this income of 4,000 received in advance was it for. Obviously, our adjustments will give us more clarity in terms of that. So now let us go and check the first adjustment, and it says on the 31st of December 2016, the following adjustments were required. This transaction has not yet been taken into account, and they say ignore all VAT implication for this question. That means don't put VAT into your mind whenever you do all these entries. There is no VAT implication in this journal entries. So now it says no entries have yet been made to reverse the previous year's prepaid expense related to water and electricity. It means the prepaid expense that we see there, it relates to water and electricity. And the income received in advance relating to the service income. That means now we have to reverse that prepaid expense with regard to water and electricity. So now let us immediately go and check if how much is that reversal of the prepaid water and electricity. Therefore, now in the trial balance, we see that there is a prepaid expense, and they say this prepaid expense is water and electricity. And water and electricity is an amount of 3,000. And I've been telling you that whenever you do a reversal, you record an entry on the opposite side, meaning our prepaid expense, which is an asset, when we cancel it, it must be transferred or be recorded on the credit side because it is on the debit side. And the reversal of the debit side is the credit side. So now we are reversing the prepaid water and electricity, meaning now we have to credit prepaid expense, meaning we have to credit our prepaid expense, and after crediting prepaid expense, we debit the expense that relate to that prepaidness. So now it will be 3,000 on the credit side, then we debit water and electricity. We debit water and electricity. Water and electricity. So now we debit water and electricity by 3,000 rands because what was prepaid was water and electricity. And in this case, our prepaid expense is credited. Why are we crediting that? Is because the prepaid expense was on the debit side, but now it was no longer prepaid by the end of the current year. Then we have to reverse and record prepaid expense on the credit side. Therefore, now here is our prepaid expense recorded on the credit side of our adjustment. So now remember once again that I always say that there is no need for us to record the credit side in our financial statements. There is no need for recording this because the minute we credit our prepaid expense by 3,000, we automatically have cancelled our prepaid expense which was on the debit side. So now if this has been cancelled, therefore now it will not affect our financial statements because in the ledger account this has been cancelled automatically, hence we record this on the credit side. So now let us go and record this, which is the debit side of this entry in our financial statements. So now we see that water and electricity is always is on the debit side, meaning now under our journal entry, our water and electricity, which is an expense, is increasing. And expenses are recorded in the income statement. That means now under water and electricity, we have to add 3,000 and to say plus 3,000 under our income statement. And let me say this once again. Whenever you do reversal entries, the expense that is being reversed, or the asset or the liability, in fact, that is being reversed, you don't record it anywhere. You leave it as it is. In this case, the asset that was being reversed was the prepaid expense, which was prepaid water and electricity. And you don't record that in the financial statements. Even if you do record, you still not be penalized. But you need to know that you must do a reversal of that. So now, the reversal of an asset or the reversal of an expense, that means if you reverse prepaid expense or reverse accrued expense or reverse accrued income or reverse income received in advance, that you don't have to record it in the financial statements because you have already cancelled it by doing the reversal entry. So now we have recorded the first part, and there was a second reversal that needed to be done. And that second reversal, they said it was with regard to the income that was received before time, meaning income received in advance. And that income received in advance was related to the service income. That means it related to service income. Therefore, now we have to make a reversal of that entry too. So now here was the income received in advance. And we know that income received in advance is a liability. That is why the income received in advance is recorded on the credit side. And to cancel or to reverse an entry, you record it on the opposite side. And the opposite side is the debit side. Remember, this is the debit side of the trial balance. And this is the credit side of the trial balance. So now we record that on the opposite side. It means our income received in advance must be recorded on the debit side. Then after, you do nothing after that. Then after, we have to credit our service income, which is the one that was being received before time. This money was received because it was the service income. So now we are recording that reversal. When now we have to debit our income received in advance, as I said. Debit income received in advance. Debit income received in advance. And that income received in advance will be an amount of 4,000 rands. Remember, I said that whenever you reverse an asset to a liability, you don't record that in the financial statements. Again, this will not be recorded in our financial statements. Why that is the case? It is because we have already cancelled this, because it was 4,000 on the credit side and we're recording now 4,000 on the debit side. Therefore, now this will be 4,000 minus 4,000, we get 0. So now this has been reversed already. However, the contra entry will be service income because this was received before time because of the services that were rendered in advance, or the income received for the services rendered to the customer. Therefore, now this will be a service income. It's money that was received before the service was rendered to the customer. Then this is service income of 4,000 rands. So now this must be recorded under our service income in the income statement. Therefore, now we go to our income statement and we check for the service income. Therefore, now our service income will have to be increased by an amount of 4,000 rands. Then we say plus 4,000 rands. Remember, the reason why we record this under our service income is because this was the income received in advance for the main activity of the business, which is the rendering of the service. So now that will definitely have to affect our service income. Then now we have accounted for that in our financial statements and it is completely done. So now let us again check for the next entry that needs to be recorded. The next entry that needs to be recorded is adjustment number B. This was adjustment number A. Therefore, now we are doing adjustment number B. Let me just write that as adjustment number A. This was A. And this was A. Then we are done with A. Then we are doing adjustment number B now. Adjustment number B. Adjustment number B. Then let us check what we are required to adjust under number B. Number B says that half of the water bank loan needs to be repaid on the 31st of May. Okay. And interest on the water bank is still outstanding. So there is interest outstanding and half of the loan must still be paid or will be repaid on the 31st of May 2017. Now remember, the end of the accounting period for the current year is 31st of December in the year 2016. This is where we are sitting. This is the end of the accounting period. This is where the business is sitting as we speak now. So now the payment will take place in the year 2017. That means from December we have January, we have February, and we have the month of March. This is the year 2017. So now January, February, March. That means in the next 3 months, a payment of the half of the loan will be made. So now anything that is payable within 12 months, that means in a period less than 12 months, it becomes a current liability. In other words, they are telling us that in the first statement that half of the loan is the current liability. And how much was our loan? Our loan was 50,000 rands. Here is the loan of 50,000 rands. And they say half of that is payable in the next 3 months, which is in the next month of March, which is 31st of March in the year 2017. Oh, sorry, that is May, not March. Therefore, now that means it will be March, April, May. That is 5 months. March, it will be April. Then it will be May after. So now that means in the next 5 months, the next payment will be made. So now if the next payment will be made in the next 5 months, that means it becomes a current liability. Therefore, now we can go to the statement of financial position and we say half of the loan will be paid. Therefore, now if half will be paid in the next 5 months, therefore now half will be remaining as the non-current. Then we can just say divide by 2, then half will remain. Therefore, now 25,000 will still be a non-current liability. So now we say 25,000 rands. Then half of that will be a current portion of the loan. Then we can say current portion of the loan. Current portion of the loan. So now our current portion of the loan will be half of the loan, which is 25,000 rands. It will be 25,000 rands. And that 25,000 rands will be 50,000 rands divided by 2 because that is half. And half will remain and half will be a current portion and half will be a non-current portion. So now we have recorded the first part of the journal entry. And the second part is the interest aspect. And now they are telling us that the interest, which is the interest on the water bank loan, is still outstanding. That means we have to calculate the interest on the loan. And let us check how much was the loan that we have and how much interest that we're supposed to pay. So now we know that the interest is 12% and we know that the loan is 50,000. And I did calculate this before, that 50,000 multiply that by 12, we divide it by 100, it will give us the interest of 6,000 rands. 6,000 rands will be the interest that is supposed to be paid. So now we say this is the interest that is supposed to be paid. We check how much interest was already paid. And we say here is the interest that was already paid. We only paid 4,500 instead of paying 6,000. That means we still owe the bank 1,000. We still owe the bank 1,500 rands. That will be the interest that is still outstanding, because 4.5 minus 6,000 will give us 1,500. And 1,500 is an accrued interest expense. Therefore, this will be accrued interest, and accrued expense is a liability. Accrued expense is a liability. So now let us record this liability in our adjustments. Then after we immediately record that, then we debit our interest expense, because accrued expense is a liability and liabilities increase on the credit side. Interest expense will be an amount of the outstanding interest of 1,500. Then after we credit accrued interest, we credit accrued interest, we credit accrued interest, and that accrued interest will be 1,500. So now we will have to record both of these entries in our financial statements. And this is an expense. That means it will have to be recorded in the income statement, and it will have to increase our interest expense. So now we go to the income statement. Under interest expense, we say plus 1,500. So that the total of the two will have to give us the interest that was supposed to be paid for the year. And we know that interest expense for the year, or interest that was supposed to be paid, was the 6,000 that we have calculated. And now if you say 4,500 plus 1.5, that should give you an amount of 6,000. Meaning now our interest expense in total for the year will amount up to 6,000 rands, 1.5 plus 4,500. So now we have recorded the debit side of this entry. Then we need to record the credit side of this entry. This is accrued expense. Take note of that. This is accrued expense. And I made mention of the fact that accrued expense is a liability. So now if this is a liability, it will have to be recorded under liabilities in the statement of financial position. Therefore, now in the statement of financial position under trade and other payables, we're supposed to add that, and we say plus 1,500, because this is a liability being accrued interest expense, which is a current liability, and we have recorded that under trade and other payables. Then now we go and check the next. We have recorded both debit and credit. Then we go to number C and see what number C has to tell us. Then now we go to number C, or adjustment number C, and we check what is adjustment number C all about. Adjustment number C tells us that Busi is considering expanding the business, and to give himself a breather, he decided to pay the rent for 15 months, reflected in the total rent paid in the pre-adjustment trial balance. That means the rent that you see in the trial balance is for 15 months, and obviously we have to pay rent only for 12 months, guys, because in business we record expenses only for the year, then not expenses for the next accounting period. So now in this case, that means the rent was paid before time, meaning it's a prepaid expense. And we see there is our rent expense. Our rent expense is 570,000. And that 570,000 is for 15 months. That means we have to calculate our rent per month. Our rent per month first. And our rent per month will be 570,000 rands. And we divide that by 15 to get to see how much was the rent per month. Then we say our total rent that was paid, 570,000 rands. We divide this by 15 months, and it will give us 38,000 rands being the rent per month. So now if we paid 38,000 of rent per month, and they tell us that it was for 15 months, it means we exceeded by 13, 14, 15 by 3 months, because 15 months minus 12 months, it will give us 3 months. That means we have exceeded our rent payment by 3 months. Therefore, now we are able to say the rent of 38,000 times by the extra month, that will give us the total rent that we have prepaid, or the total rent that we have overpaid by. Then 38,000 multiply this by 3, it will give us the amount of 114,000, and this will be prepaid rent expense. That means the amount by which rent was overpaid for 3 months is 114,000 rands. So now we have to recognize the prepaid rent expense of 114,000. Remember, rent for the year, let me just say rent for year, which is our rent for the year is supposed to be 38,000 times by 12, meaning our rent is supposed to be 38,000 times by 12, that will be 456,000. Our rent for the full year is supposed to be 456,000. That means the total of rent in the income statement must be 456,000, meaning we have to say 570,000 minus 114,000, and this will give us the total of 456,000. If we say 570,000 minus 114,000, which is rent for the next 3 months, it will give us 456,000. So now we have to do an adjustment of the rent that doesn't belong in the current accounting period. This rent doesn't belong in the current accounting period. It was paid for the next 3 months, which is January, February, and March in the year 2017. So now we must do an adjustment for the rent that was paid before time, which is rent of 114,000 rands. So now we have to remember, prepaid expense is an asset. Prepaid expense is an asset. So now it means we have to debit our prepaid expense, because our prepaid rent is increasing. Prepaid expense, which is rent, that is 114,000 rands. And let me just write that as an asset there in brackets and say asset. Then after we record the 114,000 of the rent, 114,000. Then we credit our rent expense. We credit our rent expense. Remember, rent expense is an expense. It decreases on the credit side. And why do we credit our rent expense? It is because we want to reduce our rent expense by 114,000 so that it becomes 456,000. So now I've already shown you that our rent for the year is supposed to be reduced by 114,000 so that it can become 456,000, because our rent for the 12th month is 38,000 times by 12 month, which is 456. Therefore, it means our rent that is already recorded as 570 must be reduced by 114,000 to become 456,000 rands. So now let us record the debit side. Remember, prepaid expense is an asset. So now it means it must be recorded under assets, which is current assets in the statement of financial position. That will be plus 114,000 rands as an asset under current assets. Therefore, now the other entry will be the rent expense that must be recorded in the income statement, where now our rent expense will be reduced by 114,000 so that it becomes 456,000. Then under our rent expense, we say less 114,000 rands. Therefore, now I'm sure there's no other entry for rent. The total of rent will be 456,000 rands. There will be the total rent in brackets there. And our interest expense is also done. It will be negative there. Then now we have recorded both entries where they're supposed to be recorded in our financial statements. Therefore, now we go to entry number D. And we check what number D has for us. Adjustment number D. Let us go and check what number D has to tell us. Now we go to the next adjustment, which is adjustment number D. It says there was an error in calculation in the transaction processed previously, and it was found that 1,800 related to the insurance still need to be accounted for. There was an error in the calculations in the transactions processed previously, and it was found that 1,800 related to insurance still needs to be accounted for. That means there is an amount of insurance that is not yet accounted for, and any amount of an expense, and we know that insurance is an expense in this case. Therefore, now that insurance will have to be accounted as accrued. It means it was not yet accounted for. So now let us check for that insurance and see how much is the insurance that we have in the trial balance. In the trial balance, we have an insurance of 14,000, and they say in this 14,000 there is insurance of 1,800 that is not yet paid. In other words, when they say not accounted for, it means not yet paid. Not paid. That means we still owe 1,800 of the insurance, and any expense that is not yet paid, yet it was supposed to be paid in that accounting period, it means it becomes accrued expense, expense not yet paid, and accrued expense is a liability. And any expense that is not yet paid, yet supposed to be paid, it becomes accrued. So now it means this is accrued expense, and accrued expense, as I mentioned, that it is a liability. So now we have to increase our liabilities being accrued expense. So now we debit our insurance expense first. We debit our insurance expense because the insurance that is in the trial balance is not supposed to be that amount. It's short of 1,800. Then after, we credit our accrued expense because this is an expense not yet paid. We still owe this insurance to the insurance company. Then we credit our accrued expense by 1,800. Therefore, now that will be 1,800. Therefore, now we have to record 1.8 under our insurance expense because our insurance expense in the income statement is underestimated by 1,800. So now we say plus 1,800 under the expenses. Then we look for the credit entry, and the credit entry is a liability. As I made mention to you that accrued expense is a liability. That is a liability. So now that is the liability, meaning our liabilities will be recorded under the liabilities, meaning in the statement of financial position. That liability will go to the statement of financial position under trade and other payables. Therefore, now we'll say plus 1,800. Plus 1,800 because this was not yet paid, yet it was supposed to be paid by the end of the period. So now we go to number E. Remember, for every journal entry, guys, for the current year, it must be recorded in both statements. For every journal entry, the debit side and the credit side must be recorded in all your financial statements. But with regard to the reversals, I made mention of that. With regard to the reversals, which was number 1 and number 2, with regard to these two, you can only record one side if you want, but if you want, you can record both sides, but I prefer that you only record one side. When you come to these ones, you only record the expense side or the income side, which was this one, and the expense, which was with regard to the first journal entry. So now we go to the next adjustment and we see what that adjustment has for us, which is adjustment number E. It says a pensioner, Miss Ramalotse, was in desperate need for Busi to install a gas heated shower as she had been using kettle boiled water and buckets for a long time now. To secure Busi's service, Ms. Ramalotse decided to pay the full estimated bill before he had started the job. So now this is the money that is being paid before time by the customer. That means this will definitely be income that is being received by Busi in advance because Busi is receiving the money before time. Therefore, now it says Ms. Ramalotse decided to pay the full estimated bill. So now the customer pay money fully to us before we render the service, before he had started the job. They make it very clear. And the amount was 6,000. They say this amount is already included in the bank and services income figure in the pre-adjustment trial balance. The job will only start on the 1st on the January 2017. So now remember, we are dealing with the accounting period that end on December 2016. Say that in the trial balance. We are doing the accounting period that end in December 2016. But money was received from the customer, and that money was received for the services that will be rendered in January 2017. So obviously, this is income received for the next accounting period. That means income received in advance, and that amount is 6,000 rands. So now, if that is income received in advance, we have to record this as income received in advance. And they highlight very important sentence where they say to us that this amount was already recorded in the trial balance. They say this amount is already included in the bank and services income figure in the pre-adjustment trial balance. And they are saying this so that we can only record the reversal entry, sorry, we can only record the amount that was prepaid and bank was already taken into account. We don't have to account for bank. It was already recorded under bank, but this amount must be removed under our service income because under service income, we only record incomes that were supposed to be received in the current year. In this case, the income of 6,000 was not supposed to be received in the current year because the services will be rendered next year. So now that means the amount of our service income is overstated by 6,000 rands, which is income received in advance. So now let us do that recording, which is entry number E. Then we know that income received in advance is a liability. So now we credit our income received in advance by the end of the year. Income received in advance is a liability. Income received in advance is a liability, and that liability, it is 6,000 rands. Then after we debit service income because our service income is overstated by 6,000, which does not belong in the current year. So now that 6,000 must be removed. Remember, we already have our income statement, and under our income statement, there is a service income of 5,360,000. The 6,000 that they are talking about is already inside here. of which this 6,000 is not supposed to be part and parcel of the incomes for the current year, because it belongs next year. Is income for the services that will be rendered next year. That is why now it will have to be reducing our service income. That is why again our service income is debited by 6,000 rands. Remember, service income is income, and incomes decrease on which side? On the debit side. So now if they decrease on the debit side, then it means our service income in the income statement must be reduced by an amount of 6,000, which was income received before time. And we know that the income received in advance is a liability. So now if this is a liability, therefore now it will have to be recorded under the statement of financial position under trade and other payables. So now that will be recorded under trade and other payables. It will be plus 6,000 rands. Then after now we have accounted for both the debit side and also the credit side of this entry, which is very important to take note of that all the times. So now we have recorded that all where it belongs. Then we go to number F. Number F is another adjustment once again, and that number F says to us that Mr. Mateteni, one of the debtors, Mr. Mateteni, one of the debtors, who owes the business how much? 25,000 rands. This debtor owed us 25,000 rands. Was declared insolvent. That means he was unable to pay us and was declared by the court of law to be an insolvent debtor. And they say a final dividend of 25 cents. Remember, 25 a cent, guys, is the same as the percentage. If it's 25 cents, you must know that is the same as 25%. 25 cents is 25%. Why that is the case? Because we have 100 cents in 1 rand, and there's also 100% in total percentage. So now 25 cents is the same as 25 rand. Similarly with 10 cents, the same as 10%. So now it means 25 cents in the rand was received, and his insolvent estate on the 31st of December 2016. And the balance of this account must be written off as irrecoverable. And they say no entry have been made with regard to this adjustment. Remember, this adjustment has 2 entries. There is 25% that was received. 25% received. Therefore, now there is 75% that was not received, or 75 cents. In other words, 75 cents in the rand. They said in the rand. So now if you receive 25%, 25 cents in the rand, it means 75 cents was not received. Which I said this is 25% and 75% in other words. So now 75 cents in the rand was not received and 25 cents in the rand was received. So now let us check how much was received and how much was not received. So now out of the 25,000 that the debtor owed us, we multiply that by 25 cents and it gives us 6,250. And this is money that was received, but they say it was not yet recorded. So now it means our bank account supposed to increase by 6,250. However, the rest, which is less 25,000, meaning 18,750, was completely not received. It became a bad debt. So now we have to record both sides of this entry, where we record cash that was received, because we know that 6,250 was received, which is 25 cents in the rand. 0.25 times by 25,000. 6,250 was received. Therefore, now our bank must increase on the debit side by 6,250. At the same time, there is a bad debt or credit loss, which is an amount that was not received. Credit loss of the difference, credit loss, and the credit loss is 18,750, which is 75% of 25,000. 25,000 times by 75 cents or 75%, that will give us 18,750. And now the total amount is no longer a debtor. Therefore, now our debtors will have to be reduced by 25,000 rands. Why our debtors are reduced by 25,000 rands is because part of the amount the debtor owed us was received, and part of the amount the debtor owed us will never to be received. It is declared as insolvent, a debtor that will never pay us. So now the whole amount of 25,000 is no longer a debtor to us. That is why now our debtors will have to decrease by the full amount, because part was received and part of it will never to be received. So now let us record all these entries where they're supposed to be recorded. Our bank, we know that it is a bank overdraft. However, our bank overdraft will have to decrease by 6,250 because we had our bank overdraft as 1,770,000. Then you say minus 6,250 because this amount was received from the debtor but not yet recorded in our bank account. Remember, the reason why this becomes a negative is because this is a liability. So now this 6,250 that we receive will reduce the liability of the bank overdraft of 1,770,000 rands. And the other debit entry is the debit entry of the credit loss, which is the bad debts. And we know that bad debt is an expense. So now if this is an expense, then it's supposed to be recorded under our bad debts. And our bad debt is an expense. Therefore, now under credit losses, we record where are the credit losses. Our credit loss, we say plus 18,750 rands because we know this amount will never be received because the debtor is declared insolvent. Then after now, we record the other aspect or the other entry of this journal entry, which is the credit side. Here we have our debtors. Our debtors are reduced by 25,000 rands. That means under our trade and other receivables, we must reduce our debtors by the total of 25,000 rands, which is the debtor that was declared insolvent. So now let us go and we record that under our trade and other receivables. Then we say less 25,000 rands. Remember, this 25,000 rands, if you wanted, you could have recorded it as 6,250 plus 18,750. However, at the end, it gives us the total of 25,000 rands that our debtors will decrease by. So now that is the total of 25,000 our debtors will decrease by. And we have recorded these entries, both the debit and the credit side. Then we go to number G. And you see what adjustment number G has for us. And adjustment number G is telling us that given the current economic environment, the associated job losses and the consequent negative impacts on the setting of debts, it was then decided to adjust the allowance for credit loss to a total of 20,100 rands. So now our allowance for credit loss, after we have taken into account the bad debt that was just done in the previous entry, they say the total adjusted allowance for credit loss is an amount of 20,100. Whenever you are given this, you first have to go and check how much is the allowance that is already in the trial balance. Our allowance for credit loss is 5,000 rands. So now we have to say allowance of 5,000. We compare that with the new allowance. That means we have to say 20,100 minus 5,000. So now we get 15,100 rands. That 15,100 is the increase in the allowance for credit loss, because our allowance for credit loss from last year was an amount of 5,000, but it went up from 5,000 by 15,100 and it became an amount of 20,100. It increased from 5,000 by 15,100, it became 20,100. That's what happened. This is the amount by which our credit loss increased, so our allowance increased by. Remember, this amount was already recorded last year in the statement of comprehensive income. So now we only record this amount, which is the difference between the new allowance and the old allowance. And that means our allowance went up by 15,100. And this is the only amount that will affect our statement of comprehensive income. Then the total of the allowance of 20,100 will always affect your debtors. The full 20,000, the total of the new allowance, always, if we're required to calculate it, and however amount that we could have calculated here is the one that will immediately affect our debtors in the statement of financial position. So now it means under our debtors, we first have to say minus 20,100, the amount that we have calculated. However, now when we do the journal entry, we have to split those two and we check how much will go to the income statement and how much will go to the statement of financial position as a part of that. So now we go to the general entries. And under our general entries, we record, as I mentioned to you, that we record only the amount of 15,100. This is the one that comes here. Only the difference that comes here. So now general entries, we record it where we debit our credit losses. We debit our credit losses. Remember this 15,100 that we have calculated the difference, where we said 20,100 minus 5,000 of the allowance, which gave us 15,100. This is the amount that we estimate that our debtors will not pay us by the end of the next year. So now we estimate that 15,100 will not be received. That means this is an estimated credit loss. That is why the difference of 15,100, we debit our credit loss by 15,100, because this is our projection or our estimate that 15,100 out of the debtors will not pay us. Then after we record the credit side as the allowance for credit loss, where now our allowance for credit loss is increasing. Allowance for credit loss, our allowance for credit loss is increasing by 15,100. So now our allowance for credit loss, remember in the trial balance, our allowance for credit loss in the trial balance, it was an amount of 5,000. Allowance for credit loss, it was an amount of 5,000. This was the allowance. It was 5,000, but it went up by 15,100. That means we increased by 15,100 and it became 20,100. That's what happened. This is the amount by which our credit loss increased by. So now that is why we credit our allowance by 15,100, so that we say out of that allowance that we see in the trial balance of 5,000, we add 15,100 so that it become the new total allowance for credit loss of 20,100. So now that is why the journal entry is the way it appears. So now we have recorded that. So now let us record this in our financial statements and in a just more different approach, because I've already done it. 15,100 to go to our credit loss, or you can record this separately as a one line item. Then this one will go to the income statement of financial position, and we have already recorded that, which if we want we could have recorded it in this manner. Just show you that now. If we want, we could have said 5,000 plus 15,100, because the 20,100 is made of 5,000, which is the 5,000 of the allowance from the trial balance and the increase in the allowance. This is the increase in the allowance. The allowance for credit loss increased by 15,100. We could have recorded it here if we wanted in the statement of financial position. However, I just prefer that we record the totals also to eliminate the space. So now we have recorded this adjustment to where it is supposed to be recorded. Then now adjustment number G. Adjustment number G, only two adjustments are left. Adjustment number G says to us that depreciation needs to be provided on assets as follows. Equipment is depreciated at 10% per annum on the straight line method. The estimated residual value of the equipment is estimated to be 10,000 rand. So now we have to calculate our depreciation amount. So now we start with the depreciation on the asset being equipment. So now we are doing depreciation on equipment, and they say it is on a straight line method. depreciation on equipment is on a straight line method. So now we know that it is the cost less residual value. It is the cost less residual value or scrap value. And the residual value in this case, it is given to us as 10,000. We first have to go and check how much was the cost of this equipment. Check how much was the cost of the equipment, and the cost of the equipment is 2,500,000 rands. Then 2,500,000 rands will less 10,000, which is the value of the equipment after the useful life, and this will give us the so-called depreciable amount. We say 2,500,000 minus 10,000. This will give us 2,490,000 depreciable amount. Let us check how many years will this asset take, and they say it will be for 10 years, which is 10%. 10% is the same as 10 years. So now in this case we have 10%. Remember, if you want to calculate this into number of years, you can just say 100 divided by 10. That will give you 10 years. That means 10% is the same as 10 years. Therefore, now 10% means in this case we have to multiply by 10%. We multiply that by 10%, and after multiplying that by 10%, it will give us the depreciation for the year, and depreciation for the year will be 249,000 rands. Remember, if you were given 10 years, not 10%, you are still going to say 2,490,000. 2,490,000 divide by 10. If you are given this as a number of years, if you divide this by 10, you still get to the same 249,000 as the depreciation on equipment for 1 year. And these equipment were there in business for the full accounting period. So now let us record this depreciation site, and we do a journal entry for this. This is number H that we are doing. Number H that we are doing. Then we debit our depreciation, and we credit accumulated depreciation. We credit accumulated depreciation by 249,000 rands. 249 accumulated depreciation on equipment, just to be clear. And this will be 249,000 rands. Then there will be another accumulated depreciation for another asset, I think so. Depreciation on vehicle. Let us check if is there any other depreciation in case. Yes, they said to us vehicles are depreciated at 20% per annum on the diminishing balance method. So now, and they further say land is not depreciated. Land is not depreciated. So now in this case, we record or calculate the depreciation for vehicles, and our depreciation for vehicles will be cost less accumulated depreciation. Cost less accumulated depreciation. Why? Because this is on the diminishing balance method. Diminishing balance method is cost less accumulated depreciation, where we look for the cost of this asset, and the cost of this asset is the one that appears in the total balance, which is the cost of the motor vehicles. And the cost of our motor vehicles is 2,550,000, and we say 2,550,000. We minus the accumulated depreciation on vehicles, and the accumulated depreciation on vehicles is given to be 800,000 rands. Then we say minus 800,000 rands. That will give us the depreciable amount. We say 2,550,000 rands minus 800,000. That will give us 1,750,000 rands. Then after we divide by the useful life or multiply by the percentage depending to what is given. If it's a percentage, we multiply. If it's useful life, we divide. And we are given a percentage, which is 20%. So now we multiply by the percentage. Therefore, now we have to say times by 20%. Then we check that times by 20%, it gives us 350,000 rands. It gives us 350,000 rands, which is depreciation for the year. So now at the same time, once again, if you wanted, you could have converted the 20%. You can say 100 divided by 20. That will give you 5 years. Meaning if you wanted, or this could have been given in terms of years, then if it was 5 years, it will mean it's the same as 20%. And how will you have done that? You could have said 1,750,000 divide by 5 years. That will still give you the same 350,000 rands. Either you convert into years, or you are given in years or in percentage, you still get to the same depreciation on vehicles as 350,000 rands. So now let us record the depreciation here as 350,000 rands. So now our total depreciation will be the sum of the two depreciation plus 249,000 rands. That will give us 599,000 rands. 599,000 rands. So now our depreciation expense in the income statement will be 599,000 rands. Where there's depreciation, let us check our depreciation. Here is our depreciation. It is 599,000 rands. 599,000 rands. And that 599,000 rands is made of 350,000 rands plus 249,000 rands. Then after we go to the next entry, where now we have to record the accumulated depreciation where they belong. Remember, these are the accumulated depreciation that must be recorded in the statement of financial position. So now under statement of financial position, we record 249 and 350,000 rands. In the statement of financial position, we record 249,000 and we also record 350,000 rands. And after that, I think we have covered all that needed to be covered with regard to the property, plant, and equipment note. Then now we go to number I, and number I says to us, at the end of the year, there was only 300,000 rands worth of consumable items on hand. That means unused being an asset. So now the value of the consumable items or the value of inventory of consumable items amounted to 300,000 rands by the end of the year. How much was the consumable that was purchased during the year? We know that consumables that were bought during the year were 500,000 rands. That means if we had 500,000, it means we must have utilized 200,000 value of the consumables. Then what is left now will be 300,000 rands. That means the consumable items that must be recorded in the income statement will be 200,000 rands. So now let us go and we minus that immediately. Under our income statement, we have to subtract our consumables by 300,000 rands so that what was consumed becomes 200,000 rands of consumable items. Then after now we say there was consumable that were left, which is 300,000. Therefore now if it's 300,000, it means 200,000 was used. And if 200,000 was used, what is left will be 300,000 value of the consumable items left on hand. Let me then do a general entry for that, because general entries are always very important to understand. So now there's consumable items left by the end of the year, that becomes inventory. Therefore now we debit consumable on hand, consumables on hand, which is an asset, consumable on hand, which is inventory or asset, and that is 300,000 value of the consumables. Then we say consumables used or expense and our consumables used or expense will decrease by 300,000 because we have inventory that is left by the end of the year. That is why now under statement of comprehensive income, we subtracted our consumables by 300,000 because our consumable expense or used is decreasing by 300,000. And in the balance sheet, we recorded 300,000 positive as the total consumables left by the end of the year. So now that is exactly what we have done. We have recorded 300,000, there is 300,000. And for this, there was not even a need sometimes to do this because this was already accounted as an expense in the income statement. So now even this calculation was not relevant because we know that at the end of the year, it is just 300,000 of the consumable items. Then we have recorded the expense in the income statement as negative, where we reduce our consumables by 300,000 rands. So now we have accounted for journal entry number J. Then now let us check what is the next adjustment has for us, which is now almost the last adjustment. The last adjustment says an error. That means an error took place. An error was made when the following transaction was processed. They debited water and electricity by 3,500 and they credited trade payables by 3,500. This is what they have done. Then it says the correct amount should have been 3,050. So now the correct amount should have been 3,050. They tell us what was the correct amount. So now let us check what was done and what could have been done and how the error is supposed to be corrected. What should have been done and what was done and what is the correction of the error. So now let us do that. We know that they could have done this, but they've done this. That for now we have to correct the error, which is the last journal entry. In this last journal entry, please don't, others will just be the workings because they are not necessary for the calculations. I'll just show you everything, what could have been done and what was done and how to correct the error. This is the last one. Let me just say what was done. What should have been done, in fact. What should have been done. What should have been done. In other words, they should have debited. They should have debited water and electricity by the amount of 3,050 and credit trade payables. And credit trade payables. And credit trade payables. Which is 3,050. This is what should have been done. Then we look at what was done or what was processed. We see what was done. This is just my workings, guys. What was done. And we know that what they did was to debit water and electricity by 3,500. This is what they have done. So we record what they have done. They debited water plus electricity by 3,500 and they credited trade payables. Trade payables by 3,500. And now let us correct the error now. We are doing the correct entry now. Correct entry. We are doing the correct entry. Correct entry. Or correct the error. This is the error corrected. Now, how do we correct the error? They have overstated the water and electricity and together with the trade payables, because they recorded 3,500. This is what was done. This is what they have done. They debited electricity by 3,500 instead of 3,050, because this is what should have been done. And now what should have been done is lower than what was done. That means they have overstated water and electricity by 3,050 minus 3,500, and that means 450 was overstated. So now we have 450 that is overstated. And similarly, the trade payables were supposed to be 3,050, but they recorded 3,500 instead of 3,050. So now they recorded 3.5 instead of 3,500. So now it means again the trade payables were overstated. Instead of being 3,050, they recorded 3,500. And the difference will again be the same amount, obviously 450. That means the correct answer now is to reduce water and electricity and reduce trade payables. So now we reduce our water and electricity on the credit side because this is an expense. And we debit our trade payables. We debit our trade payables by 450, and we credit water plus electricity. Water plus electricity. Water plus electricity by 450. So now that means we have to reduce our trade payables in the balance sheet by 450 and reduce water and electricity in the income statement by 450. So now let us do that as we have said. Our statement of financial position under trade payables will decrease by 450, then we say less 450. And in the income statement, we have to reduce our water and electricity by 450. Water and electricity by 450 because they were overstated by 450 because of the error that was done. So now with that, let us check if have we perhaps missed anything or not. Then we give the total of all the expenses, because now we have done all the adjustments, and immediately when we have done all the adjustments and recorded them in their respective financial statements, and from here everything's supposed to balance. And now from here we can just do the total of all the incomes and all the expenses. Then we check if is there a profit made, then we continue from there. So now we say total of our service income is 5,360,000 plus 4,000. Then we minus 6,000. Minus 6,000. Then this will give us a total of 5,385,000. 5,358,000. 5,358,000. Then we totalize our expenses. Credit loss will be 7,500 plus 18,750 plus 15,100. This will give us 41,350 in brackets. Then our salaries were not affected, they remain 400,000. We have 200,000 of the expense. Then we have rent, which is already 456,000. We have insurance, and our insurance is 14,000. 14,000 of insurance plus 1,800, and insurance becomes 15,800. Our insurance becomes 15,800. Then we check our water and electricity, which is 85,000 plus 3,000. minus 4,500. That gives us 83,000. It is 85,000 plus 3,000 minus 450. 87,550. 87,550. That is the total depreciation, 599,000. Then this will give us total expenses before we take into account finance cost. Our total expenses will be plus 599,000 plus 87,550 plus 15,800 plus 456,000 plus 200,000 plus 400,000 plus 41,350. That will give us, then we have to also take into account, check if does it balance, doesn't balance. Okay, we have 7,500 plus 18,750, which is 26,250 plus 15,100 plus 400,000 plus 200,000 plus 456,000 plus 15,800 plus 87,550 plus 599,000. That gives us 1,799,700. 1,799,700. So now those are the total expenses before we take into account finance cost. Then we get to the profit before finance cost. Profit before finance cost. Our profit before finance cost will be the difference between our service income and our expenses minus 5,258,000. That will give us 355,000 or 3,558,300. 3,556,300. Then we say less finance cost, which is 6,000. That gives us 3,562,300. That will be the profit for the period. So now we do have our correct profit there. Then we can our profit is 3,556,000. Let me just reconfirm that. We have 3,556,300 minus 6,000. 3,558,000, not 550. 3,558,300. 3,558,300 minus 6,000. That will give us 3,552,300. 3,552,300. 552,300. Let me just reconfirm that again. 5,358,000. 5,358,000 minus 1,799,700. Okay, 3,558,300. That is correct. Minus 6,000. Then it gives us 3,552,300. Okay. Then that will be profit for the period. Profit for the period. So now if we had to do the statement of changes in equity, which was not required at 31st December in the year 2016, there will have to be an opening balance, and our opening balance would have been the capital of 3 million. This statement was not required. Remember, we had our capital which was there in the beginning of the trial balance, and that capital amounted to 3 million, and that was the capital which becomes an opening balance of 3 million, and this will have to be recorded. Then after we record profit for the year, then we'll have our profit for the year, and our profit for the year would have been 3,552,300. Then we'll have to subtract our drawings, and our drawings, they amounted to an amount of 50,000 rands, if my memory still serves me. In the trial balance, we had our drawings that amounted to 50,000 rands, and there was no adjustments with regard to drawings. So now we have recorded that 50,000 as negative. Then we'll get to the closing balance, and the closing balance would have been at the end of the accounting period, closing balance, on the 31st of December in the year 2016. Then we calculate our closing balance from there. Calculate our closing balance. Closing balance would have been capital plus the profit plus 3 million minus 50,000. This would have been a total of 6,502,300. 6,502,300. Therefore, now we can still do that calculation because the statement was not required. So now, since the statement was not required, we just say opening balance less drawings plus the profit of 3 million from the income statement, 3,252,300, 3,252,300, 3,552,300. That will give us the total, which is the same total that we have calculated in the statement of changes in equity, which is here at the bottom, 6,502,300. So now that will still be the total at the end whenever you are not required to do the statement. It will give us the same 6,502,300. And that will be our equity. Therefore, now let us calculate our property, plant, and equipment total. And we'll see how much do we have under assets. We have 3 million plus 2,500,000 plus 2,500,000 and 50,000. And we minus 500,000. We minus 800,000. We minus 249,000. We minus 350,000. That will give us the total of the property, plant, and equipment, which will be, just use a different color, 6,151,000. That will be 6,151,000, and that will be the amount of the property, plant, and equipment. Then under our trade and other receivables, we have 288,000 plus 114,000 minus 25,000 minus 20,100, and that will give us the total of, it just reconfirm, 2,880,000 plus 114,000 minus 25,000 minus 20,100. That will be, yes, the correct total of our trade and other receivables. close brackets, total of 294,900. That will be the total of trade receivables. There was no bank. Liabilities are in total non-current the same. Then our trade and other payables, let us calculate that. It will be 1,075,000 plus 1,500 plus 1,800 plus 6,000 minus 450. And we check how much do we have under trade and other payables. It is 1,083,850. Then our bank overdraft would have been 1,770,000 minus 6,250. Then this could have came up to the total of 1,763,750. May just adjust that to 1,083,850. Then we do have our current portion of the loan. Then add the total of the three plus 1,083,850 plus 25,000. That will give us the total of the current liabilities as the total of 2,872,600. 2,872,600. Then we add our non-current liabilities plus 25,000. This gave us 2,897,600. And we add our equity, which is 65,02,300. That gives us 9,399,900, which is under equity and liabilities total here. This will be 9,399,900. That is our total equity. Then we go to our assets, starting with the current assets. Let us add our current assets, which is 300,000 consumables, and we say plus 294,800. That will give us a total of the current assets as 3,248,900. And we add our non-current, which is plus 6,151,000, and this will give us the same amount as of 9,399,900. And if we see now, everything is balancing and we are fine with that. Yeah guys, with that being said, let me say bye bye. Thank you.